Welcome back to Bite Size Business, the channel where we use financial metrics and ratios to gauge the financial health of companies. In today's video, we will start a new series on defense contractors and take a bite into Lockheed Martin. Lockheed Martin is a defense contractor worth over $100 billion and is behind the famous C-130J Super Hercules, the Orion spacecraft, the SR-71 Blackbird, and the U-2 spy reconnaissance plane. Lockheed was founded in 1926 with roots back to 1912 by Alan Lockheed, which is actually spelled L-O-U-G-H-E-E-D, and it was changed to the L-O-C-K so that the name wouldn't be mispronounced by investors. It was also founded by John Northrop and a few others in Hollywood, California. That John Northrop name is pretty important because Northrop actually founded another defense contractor called Northrop Grumman, and that's probably one that will show up within the next few videos. In 1929, the majority of the company, I believe it was 87%, was bought out by the Detroit Aircraft Company, but they would go bankrupt during the Great Depression. Investors would buy the company out again for $40,000. This is equivalent to about 850,000 US dollars in today's currency. In fact, the plane Amelia Earhart and Fred Noonan would go missing in was a Lockheed Model 10 Electra, which is this plane shown here. That was the model, which is just an interesting fact. It was their second really successful commercial plane after the Vega. The Model 10 and the Vega sold really well. And they sold well enough for Lockheed to be able to develop the Model 14 as well as the Model 12, but the Model 14 would become the basis for the Hudson Bomber, which was, ironically, 100 were license-built units for the Japanese Imperial Army before the break of World War II. And so an American company ended up selling to the other side of the war before the war started, which I think is kind of ironic. Lockheed was also the first company to receive an American government bailout in 1971 to the tune of $1.4 billion, which it paid off with interest in 1977, so it only took 6 years. In 1993, it acquired General Dynamics Aircraft Division, which was the builder of the F-16. And in 1995, it would merge with Martin Marietta, the maker of aircraft explosives. As a result of the merger, they changed the name from Lockheed to Lockheed Martin, and they spun off Martin Marietta's, which was a materials company, as well as L3 Communications, which is now called L3 Harris, which is another defense contractor. Since Lockheed has acquired and divested many businesses to and from other defense contractors in an industry consolidation to push Lockheed to be pretty much a fully aerospace-based company. Over 80% of their revenue now comes from the aerospace side of the business. And that leads us into the starters. Taking a look at our starters, we see a total revenue of $71.3 billion. This drops down to $10.4 billion in EBITDA and net income of around $6.7 billion. We can look at the balance sheet and look at the most recent quarterly report and see that they have around $55.5 billion in assets. They also, however, have $48.3 billion of liabilities. Of that, $19.3 billion of total debt. This leaves us with a shareholder equity of $7.2 billion, which is quite low for a company worth over $100 billion. Now looking over at the cash flow, we see an operating cash flow of $8.3 billion and a free cash flow of $6.5 billion. The company also paid $3 billion in dividends and bought back a whopping $5.7 billion of stock in the last 12 months. Jumping into the main course, we can review some of the stuff off of those financial documents. So today's company was Lockheed Martin, who trades under the ticker symbol LMT. They're in the defense industry, but more specifically, they focus on aerospace. In the last 12 months, they've done revenue of $71.3 billion, which is up considerably from their 2022 numbers. A large part of this revenue spike that I will show a graph of later comes from some of the conflicts over in the Middle East and the Russia-Ukraine war. The company's EBITDA has also grown, coming in the last 12 months, $10.4 billion, up from $8.7 in 2022. Net income has grown a little bit, only $900 million of growth since 2022, but they posted net income of $6.7 billion, which is up from $5.7 in 2022. Total debt sits at 19.3 billion, assets at 55.5 billion, and liabilities at 48.3 billion, leaving us with a total shareholder equity of 7.2 billion. Free cash flow has been pretty strong for the last 3 years, coming at over $6 billion each year, coming at 6.5 billion for the last year. Stock buybacks have been huge in the last 3 years, doing 5.7 in the last 12 months, $6 billion total in 2023, and almost $8 billion in 2022. The cash dividend is slightly lower than that, coming in around $3 billion each year. One thing you don't see too frequently on a lot of these companies is a drop in yearly dividend payments. As we can see, it went from 3,056,000,000 to 3,048,000,000. That is likely from that stock buyback. As I was saying, like the company is only worth about $100 billion, and I say only like that's small. But the $8 billion, $6 billion, and 5.7 billion that they bought back does represent a large portion of the company. I mean, that is 8% of the company, 6% of the company, and almost 6% of the company again. And so even though they've been raising their dividend, it looks like they are buying back more stock as a percentage, and so there are less shares on a percentage compared to that dividend hike. And so while the average shareholder received more, the actual amount they paid was less. Taking a look at the ratios, we can see they have a debt to equity of 2.68, which is pretty high, a debt to EBITDA that's not bad at 1.86, an EBITDA margin of 15%, and a net profit margin of 9%. Buybacks as a percentage of free cash flow and net income sit in the mid 80s, which is not bad. That just means that they could continue to actually double those efforts if they so choose. We have a revenue CAGR of 4%, which is not bad for a company that relies on government spending, an EBITDA CAGR of 9%, and a free cash flow CAGR of 3%. All pretty good numbers considering that this is a company that is pretty much primarily dealing with the US government. Taking a look at the comparisons, we can see that high debt to equity I was talking about, but a low debt to EBITDA and a neutral EBITDA margin and neutral net profit margin. Most of these companies, just to say it in the beginning, are going to get a green light, I believe, because even if they have a higher debt to equity or higher debt to EBITDA, the fact that they're government defense contractors and the fact that Lockheed Martin is the reason the government will bail out companies, it's unlikely any of these companies will go anywhere as they're just too important to the federal government. And so they are going to get a green light. That being said, they're very deserving with that low debt to EBITDA coming in at like 1.8 times. That is insanely low. They could pay that off in no time if they chose to. Taking a look at the dessert section, we can see in the last 3 years they've done total buybacks of $19.6 billion, which that is, if they were to do that in one lump sum now, that would be almost 20% of the company. And that is an insane amount of stock buybacks to do. It's numbers you don't see too frequently. Skipping over to the total dividends, seeing that 9.1 billion, that is another crazy number to see because that means they've done almost $30 billion of distribution back to shareholders in the last 3 years. And that is a crazy amount for a company to do. And again, there's that full number, that 28.7 billion. That is an insane number for a company of any size, especially one that's worth around that $100 billion mark, because that is 30% of the total worth of the company in 3 years, which that is a pretty crazy number to see. The craziest part to me is this 97% payout ratio when it comes to their EBITDA over that period. So they did about $30 billion of EBITDA over that time, and they paid out 28.7 billion. That is a huge number for a company to pay out, and so that's something we need to watch because they are paying out the vast majority of their earnings, and so that could be an issue in the future if earnings dip. Given that this company has done so much in-stock buybacks over the last couple years, I wanted to make a big point and show the shares outstanding graph. So since 2010, they've bought back a large amount of shares. They had year-end 2009, they had 389 million shares. Now they're sitting at 239 million shares, which means that they've bought back 150 million shares over the last 15 years. and that's showing that they're buying out about 10 million shares a year, and that starts to get a little more expensive in recent years. Just looking at a flat average, but we can see, a steep drop over after the 2008 recession up till 2012. Um, One thing that's interesting is um, defense is pretty political, and so we can kind of see this would have been um, the first term of Obama. They dropped pretty heavily in their share count and kind of steadied out through his second term, um, and kind of lowered around in 2016. Then when Trump took office, we had 4 years from 2016 to 2020. It was pretty consistent again. Then we had Biden's term. It was pretty consistent, just slow for the first couple years. Then when you had the Russia-Ukraine stuff pick up, it kind of dropped, and then now you have the Israel-Palestine stuff, and so it's dropping even more. I love macro trends. This is the website that I use for a lot of the graphs, and one thing that they have is an EBITDA one, and that's one I want to make a big point on because this is where you can really see the benefits or the drawbacks of the political affiliation of this. And so if we look back in 2010 year end 2009, we can see a lot of the political aspects of this. So under Obama's presidency, from that 2009 to 2016, we see that their EBITDA went from 5.3 billion and up to around that $6 billion mark. Then you have Donald Trump take office, and it goes from $6 billion up to, this is the end of 2020, from $6 billion to almost $10 billion. So it sees a 60% growth. And then under Biden, it goes up a little bit towards the beginning, and then it starts to kind of taper down and pick back up in recent months or recent years with the newer conflicts that have been happening. Now, that leads me to the check, because while Trump is coming back into office and they grew a bunch over him, Trump has been exceedingly budget conscious in this electoral cycle, and so that could lead to some budget cuts. And with the defense being over $800 billion a year, there's probably some money they could cut back there. And so it would be relatively likely for this to drop a little bit. And so um, I've noticed it a lot with the checks for a lot of these companies, is the uncertainty of what's going to happen in this new political landscape, especially with a president that is so budget conscious for their second term. And so any company that deals a lot with government spending is going to have issues when it comes to a new presidency, because things change. And the market does not like change, and so that could see some drawbacks with some shaky guidance possibly out of some of these defense contractors. And so that's a point I wanted to try to get across. I hope you enjoyed this video on Lockheed Martin. If you did, please feel free to like, comment, or subscribe. Please let me know in the comments if you have a specific defense contractor you want me to do. There are a lot of companies in this industry or this sector, and so it might be a little tough to get to all of them. And so if you have a specific one in mind that you would like me to cover, please let me know. Or if you have a specific company in general, it doesn't have to be a defense contractor that you want me to cover, I will gladly do it if you recommend it. So thank you for watching, and I hope you enjoyed the video.